Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have John Casmon. John is the host of Target Market Insights podcast. He's the founder of Casmon Capital Group, a private investment firm based out of Chicago, where he and his partners have closed on over 600 units worth over $58 million. He is also the co-founder of the Midwest Real Estate Networking Summit. John Casmon, welcome to the show, my man.
Juan, thanks for having me on. It's a pleasure to be here today.
Yes, sir, man. It really is the pleasure. And, we have met, we haven't met in person, but we had several calls, group calls, and where it's really beneficial. They're sort of like mastermind calls, for lack of a better word. But, these are really powerful because, it gets to keep us on track and what we're doing. And, and we're able to help each other out and give each other advice. And so we feel it was a good idea to get on my podcast, and maybe down the road I'll be on your podcast as well. So hopefully, that happens, and I would be looking forward to that as well. So, John, yeah, it's great to have you on. Tell us a little bit about your background. This is obviously multifamily, and what we're going to discuss here. But tell us a little bit about your background. I know that you had a little bit of GM, General Motors, in you. So tell us a little bit about that, and fast forward to today.
Absolutely. So I'm a multifamily syndicator today, but before that, I had a career in corporate America working in marketing. So advertising and marketing, to be specific. I worked at General Motors, as you alluded to, and I was there from 2007 to 2011. So depending on your viewpoint, it was either the best of times or the worst of times. But I will tell you, it was very intriguing watching, well, intriguing is not the word I would use. It was scary as hell watching everything happening that took place during the economic downturn, because I was in the city at the epicenter of it, and I was at the company at the epicenter of it. So I saw it both in my day job, and I saw it also looking at CNN or watching the news. I remember distinctly watching the head of our department go on CNN. I mean, literally early in the day, around 3 o'clock, she and I spoke. I asked her, hey, how's everything looking? What's going on? She told me, hey, things are fine. Just keep your head down. Do what you got to do. We'll be okay. And literally about 3 or 4 hours later, she's on CNN, I believe with Anderson Cooper or somebody like that. And she's telling them that we are in dire needs. We need to hit, we need government backing. We need help. And I'm like, you just told me things were fine. So as you might imagine, as a young executive, this instilled a lot of panic. Not necessarily in a frenzy kind of way, but just I realized, hey, I need to take control of my future. I cannot go the route of working corporate America, working at a great company, having a quote unquote good job, and allowing that to be sufficient, because at any moment that can be taken away from me. I mean, I literally watched the person who sat to my left and the person who sat to my right get laid off during that time period. So although I was, I was young and, probably underpaid a little bit at that time, but I was a stellar employee. So I was fine. But nonetheless, it helped crystallize for me that I need to create my own path and not solely rely on my employer. So at that time, around 2010, like many people, I was looking at other options from 2008 through 2010. And ultimately, around 2011, I decided to move to Chicago. And part of the reason I wanted to do that was to focus more on real estate investing. So we started investing. Our first property was a house hack duplex. We bought a duplex in a neighborhood in Chicago, lived in one unit, rented out the other unit, and that worked really well. About 18 months later or so, we bought a 3-unit building, saved up all of our money. That worked well. We were able to refinance that first property. And then from there, we had a nice amount of equity and a nice amount of capital to start investing. So that's when we really started to kind of take it to the next level. We bought an 8-unit building. We did a couple flips. And then as we started to progress, we started learning more about partnering with other people, apartment syndications, and that's kind of how we netted out where we're at today.
Got it. When did you start getting into the larger multifamily? How many years before you started getting into the larger ones? Because I know you started off with duplex, you had the 8-unit. So like how many years was that? And then before you actually decided it was time for you to get into larger ones?
Yeah, so we've been investing for about 6 or 7 years total. And I would say the first 3 years or so, 3 or 4 years, were the smaller properties. And then I would say 2 years ago is when we really got serious about large apartment buildings. We did the 8-unit, which is technically a commercial property. We did that about 3 or 4 years ago. It's 3 years ago, I believe. So we
Okay.
did that, and oh no, I'm sorry, that was 4 years ago. So we did that property, and then that property was kind of my, I don't want to call it a test, but that was my ability to go out, get commercial financing, hire a professional property management company, and gain all that experience before we kind of scaled and started bringing in other investors into our fold. So we wanted to go through that entire process ourselves. So we were not just knowledgeable from a book smart standpoint, but actually had real world experience in the philosophies that we were implementing.
Yeah, and also give you a ton of confidence that, knowing that you can take down a, commercial building, pretty much, a smaller size, but, they give you a ton of confidence. So I want to ask you, what was the thought process on getting into larger ones versus just keep acquiring smaller ones? Why not just you go after a 10 unit, 15 unit, 20 unit on your own, with your wife, and just build a large portfolio that way versus getting a smaller piece, in a larger property, right?
Yeah, I think there are a couple things, and everyone's strategy works for them. For us, I think scale was really important because scale provides so many advantages that if you're going the smaller route, it just doesn't have. And I'll give you a clear example. One of the
Okay.
biggest challenges I had with that 8 unit building, even though we had professional property management, it was really too small to get the attention that it needed. I mean, you can't really have on-site property managers. They charge you for, anytime they come to the property, I got a fee that was put to it. So really, if you can get to 50 or 70 units, somewhere in that size, that's the size where you can start to have on-site property management. So for us, it was more about, okay, if we're going to grow this into a business and we're going to bring in other investors, it needs to be big enough to actually operate as a business. And we
Hmm.
just felt that the smaller stuff didn't really allow it to happen. Now, I do own a 28-unit building where we have property management in place and things like that. And I would tell you, even with that property, when I compare that to the larger stuff in our portfolio, it's just kind of night and day. And you can do it, but I think you have to have a different strategy if you're going to build with smaller multifamily properties versus if you're going, and I'm going to say 50 units, but 50 units and up, or at least big enough where you can get on-site property managers depending on that market. If you can do that, now you can really be a manager. And that's my strong set, right? My skill set from marketing standpoint is project management, overseeing budgets, overseeing vendors, overseeing teams, investor relations or client management. So when I recognized what I was really strong at, and looking at my wife, who's my partner in the business, she's got the auditor and kind of innovations background. So for her, it's overseeing all the numbers and going deep into the accounting aspect. So when we looked at what we were really strong at, it was really more of those corporate skills, those larger level skills versus, more of that blue collar overseeing the contractor on site and being at the property every single day. So the bigger the property, the easier it is to manage, which I know seems counterintuitive to maybe some of the listeners, but the bigger the property, it really is easier to manage because you have the pieces in place to manage it.
You have the scalability and you have a professional staff that can oversee the project. So you covered that, exactly the way it is. And that's reality, and, I think it takes, it takes some thought for some folks out there to realize that, hey, maybe it is better to go bigger, versus, keep acquiring smaller properties, and like you said, like you mentioned this earlier, it's okay to have different strategies. Your strategy may not be the right strategy for somebody else that's listening, but one thing that probably is more accurate is that it's going to be easier to oversee and manage if it's a larger property.
Yeah,
So
can I, Juan, do you mind
yeah,
if I give a quick example? This
yeah,
is something
exactly. Yeah, go
I've
ahead.
been
Go ahead.
thinking about because I talk to a lot of investors, as I know you do as well. And a lot of them want to do their own thing, right? They want to start out, they want to do their own small multifamilies. And I meet so many people who are interested in that. And what I talk to them about is there's so much power in working together. And I'll give you a quick example, right? People, they don't they some people get fearful of being a part of a large team or investing in a large deal, but they have no problem buying stock in large corporations. And I would liken, if you look at investing in multifamily similar to investing in stocks, people for some reason feel more comfortable investing in penny stocks in the multifamily side of things, right? So if you look at it as penny stocks versus large value fund stocks, I think it's a similar thing. If you can invest in a large apartment building, 150 units and up, in a stable environment or a growing market where there's professional property management in place. You have the lender who is super professional. And by the way, they're putting up 75 to 80% of the money, or anywhere between 65 and 80% of the money. So you best believe they're going to make sure they love this deal and love everybody involved if they're going to put up that kind of capital. You're going to have strong team members in place all around the board. So that's what you're looking at if you're looking at those large apartment opportunities versus you go to a 4-unit, a 6-unit, a 10-unit, and it's you and whoever you can find to do the work in your budget, right? So I know people want to have control, but man, it's sometimes really good to just attach yourself to a large operation where you have all the professionalism in place. You can limit your risk by being a limited partner. You can learn that way. You can learn great skills. And by the way, I still learn every day from my partners on the large stuff. So, I just really wish people could open up their mindset a little bit to thinking about how they look at investing, because there are different ways to do it. And I know it feels great to be in control and we're all entrepreneurial and want to do it ourselves, but there's a lot of power in working together and doing it in that fashion.
I love that, man. I love that because you brought up a great point that, there's a lot of folks out there that have no problem investing in the stock market where somebody else is managing your funds and they really, frankly, could care less about, your name. They could care less. They're worried about themselves. They're worried about Wall Street, and it's about what makes them better, and how they can, grow their pockets. So again, you have no control. So if you want to have control on your property, but you're giving up control in the stock market, I mean, it's kind of doesn't really make sense. But there's a couple other things that I'm going to add to that I would like to mention. And one of those is, again, if you are investing passively, what that does is it allows you to continue your career, to continue your path. So while you're somebody else is, overseeing your project, and you can just continue your path. Whereas if you're doing it yourself, it can kind of, they kind of overlap each other sometimes, where you have to have time to go see your project and go see your property, and, attendance calling or something. But you still have your W-2 corporate job over here. So there's that time thing there. The other thing that I want to add as well versus the stock market, because we brought that up, is the major tax advantages that you get in real estate that you won't get in the stock market. And, that's huge. Or in the words of Trump, huge, whatever you want to say it. So, that really is big time. So, those tax advantages, if you can get depreciation, over the years, imagine how much you can actually save in taxes. I mean, it's just big, so, I really like that you mentioned that. So, I guess we can, move over to, where you are finding these properties, what markets are you looking at, and, how did you find these properties in the first place?
Yeah, great points. So I think there's a couple things for us. I like to have boots on the ground. I know some folks can happily invest from wherever they're sitting. They live in New York and they'll buy a property in Texas. You live in California, you buy a property in Florida. I really want to make sure that someone on our team is local or can get to that property within an hour. So for us, we do look in Chicago, which is our home market. Cincinnati is another market where we focus our energy and effort. My wife is from there. We have a ton of family there. We have a lot of connections there. So that's another market that we focus on. And then San Antonio, Texas is one of the other markets. One of our partners lives in Austin, so he can very easily get to the properties and check things out and see what's going on, managing the teams there. So we like that aspect of it. That's not to say that I would never partner with someone who didn't live there, but it is something that I actually look for because I just think that it gives us a bit of a competitive advantage, whether that's finding great deals from being able to talk to brokers more frequently, getting FaceTime with brokers, or just going by the property, talking to the property management company, verifying the information. In our Cincinnati properties, I'll have my brother-in-law just kind of drive by. Hey, contractor, send me some pictures. This looks like it's done. Can you just go by, take a look, give me your thoughts, let me know if there's anything that's missing, right? So I like having that extra bit of comfort, knowing that I can put if not my own set of eyes, a trusted set of eyes on the project at all times. That gives me a great deal of comfort, and that gives me comfort to talk to my investors. I think that, we've been through enough with property managers and contractors where we know a lot of the tricks that they like to pull. And that's not to discourage anyone. It's just to understand that this is a business and some people will try to cut corners. And you have to, I owe it to my investors as a responsibility to make sure that we are doing everything in our power to protect their investment and hiring the best people, but also verifying all of the information we're receiving on a daily basis.
Yes, yes, and that's exactly what it is. You said at the very beginning is having those boots on the ground to be able to oversee a project. If you're going to be, working with partners, I think it's a very very important idea, and it should be almost be mandatory to have somebody that's nearby, where you can still have a good project, even if you don't have any local boots on the ground, but definitely it's much better. So, um, let's talk about your latest acquisition. And I know this is a two property portfolio, 388 units, if I'm not mistaken, and this was in San Antonio. So, tell us a little bit about that.
Yeah, so this is one of our partnerships where our lead partner was able to identify this investment opportunity from building a great relationship with the broker. So it's 388 units. One is 190 units. The other is 198 units. And the seller basically it's a family, and they were looking to divest of these properties. It's a great opportunity for us because they're very close to other properties in our portfolio. They're within about a 15-minute drive of all of our other properties there,
Yeah.
and it gives us a lot of flexibility on the exit. So, what the way we looked at and the way the team looked at it was, now we have four assets in this market, roughly around 800 units or so, and you know, essentially on the exit we have a ton of flexibility. We can refinance into a large package. We can sell to an institutional investor. We can hold them all. We can sell one or two off. There's a ton of flexibility. So I love that aspect of it. But the market is great. San Antonio, Texas, one of the fastest growing markets in the country. If you look at a lot of the data points, you'll see that there is great diversification. There are new jobs coming in. You've got a military base there. So you have strong workforce housing, as well as a lot of millennials who are moving there. We all know, I know you're based in Texas as well. So Texas is still a very strong growth state, the entire state of Texas primarily. But
Right.
San Antonio in particular is part of that triangle area where, again, I think you're seeing a lot of great growth. It's close to kind of the pathway between San Antonio and Austin, where we are seeing more growth between those two cities. I read a report that within the next 11 years, it's going to be one large metro similar to Dallas Fort Worth. So as we look to move forward, we do expect that growth to continue along that path. The demand for apartment housing, especially renovated apartment housing, will be there. So we think that we have a strong business plan that's been proven based on our earlier properties, that we can implement the same thing. So we know that there's a ton of demand. We know that our numbers are solid. We have the strong team in place. We've got the contractors, the property management team. So for us, this was a fairly easy deal to decide to be a part of and to do. We still have our questions and things like that we always try to watch out for, because at the end of the day, again, I talked about that commitment to our investors. One of the questions I like to ask is, where are the risks? Where are the trouble spots for investors? What are the things that can make this deal go sour? So we try to identify those things, and then we try to mitigate those risks as best as we can. Because at the end of the day, what we're trying to do is make sure we can deliver a strong product for our investors, and we deliver time after time after time.
Yes, I love that. So, what are you doing specifically, for this property? And is this more of a value add? Is it more of a yield play, or is it a combination of both? Tell us a little bit about that.
Yeah, this is a value add play. I mean, it's already kicking off a really good amount of cash, but this is a value add play where we can go in, we can spend anywhere between 5 and 6K on interior renovations. There's some, I don't want to say deferred maintenance, but there's some CapEx items that we want to address. And then part of what we do on a value add is, beyond just the renovations, we look for opportunities to increase the NOI or increase revenue. So we have a few things that we like to look at. One is doing private yards. Private yards have been able to, fetch an additional anywhere between 15 and 25 bucks in rent premiums. So on the first floor units, fence in a yard. Now you got a private yard. If you got little kids or you got a dog, you want to just let them out in your little private yard, you can do that. So people are willing to pay a premium for that. Increasing the number of either parking spots, if you're going to do reserve parking spots, or putting in more carports. That's something that we do, especially in a market like Texas, or that works well even in the Midwest. So if you're thinking about some place where it snows, guess what? I'm sure a lot of tenants would love to pay a little bit of a premium for a parking spot where their car is covered, and they don't have to get up every morning and try to, get all that snow and ice off of their car. It's a lot easier than, not having that. So I think people be willing to pay, again, $15 and $25 a month for that. So we look for things like that are fairly easy. Pet fees, if the previous or the current owner is not charging pet fees, we look to implement pet fees, rub systems, or ratio utility billing systems. I've done that a couple different ways. You can either do it where you truly implement an entire rubs play, or you can just take a look and say, you know what, for 1 bedroom units, we're going to charge you $25. For 2 bedroom units, it's going to be a flat $35. And that's something that in some of our markets we see is received and is fairly commonplace. So those are other ways we can do it. You can meter the water. So now you can take that, sub meter the water, charge these residents for the water bill as opposed to the owner paying it. So we look for all of those different ways to drive the NOI or the net operating income. And at the end of the day, it's a business. So I talked about kind of my background on the corporate side of things. What we're looking at this thing is as a business. We're looking at those sheets. We're looking at the income and expense statements. We're going line by line by line, and we're saying, how do I increase revenue? How do I decrease expenses? How do I drive the most value? And that's our business plan.
You pretty much hit the nail on the head. One of the things that I do want to point out in the San Antonio market, or not even in the San Antonio market by itself, but a lot of markets is shared workspace. So if you have any area inside the clubhouse or something like that, then that's a new it's kind of like a new trend where you're allowing this specific space to where tenants are, they're paying a little bit more. You can charge them per use per month, something like that. So that might be something that you guys can think about as well. And I do know that there's a couple other guys based out of San Antonio that are going to that, and it's there's something that they're trying, and so far it's been working for them. So for those of you guys listening out there that are also syndicators, or even if you're limited partners, that could be something that you bring up to your main sponsor, your lead sponsor, and just kind of throw it out there and see what they think, and see if it's something that works in that market. Because we're having a big trend in WeWork space, and that's like one of the hottest things right now. So if you can implement that in the on the property level, a lot of people don't want to drive out, especially if it's in the middle of the winter. Like here in Texas, we're so used to having warm weather, and if it's in the middle of the winter, nobody wants to pretty much leave. So if you can do it right there, on the property on site, then that's a perfect thing, there for increasing your revenue and your NOI specifically. So
yeah, Juan, and I think that just boils down to knowing your tenant base, right?
Exactly.
I mean, that's a little bit of market research, just talking to your property management company and looking at that. I mean, pets is another thing, right? We talked a little about pet fees, but if you want to have a pet-friendly environment, make it pet-friendly. Like, don't just charge for pets. Actually make it pet-friendly. Put in a dog park. Put in a dog wash station. Look for ways to create something that would truly attract pet owners. And that's something where when you do your market research, you want to see, what do the other apartment complexes have and what do they not have? Where can I win? Because if there's a glutton of, the same kind of product or the same kind of apartments, you're just going to be another apartment complex, right? But if you can find a way to carve out a space, meet an unmet demand, that's where you can really shine. That's where you can really drive rent premiums above even your projections. To your point about the WeWork space or co-working space, if you're going after a millennial consumer, especially if you're in an area where, household income is pretty solid, these people have discretionary income, that's a phenomenal play. That's a phenomenal play if you're going after that 27-year-old who, maybe they work from home sometimes, maybe they're an entrepreneur, maybe they have a side business or whatever the case may be. That's a great business and a great way to think about, how do I cater to this person? So I think ultimately it comes down to catering to the demographic you're trying to attract. And if you do that and go above and beyond just simply offering an apartment with the basic amenities, that's where you'll stand out and be very successful.
Yeah, I couldn't have said it better myself. That's right on. Pretty much you got to study the market, study your demographics, and cater to them, like you said. You summed it up right there. So that's awesome. So let's talk about what your role is, in this specific portfolio, and what are you doing to add value to your partners?
Yeah, so for this portfolio, as I mentioned before, marketing is my background. So we do work with some of the marketing stuff, and we also do some of our investor relations. So we, most of the general partners, I think all the general partners raised capital for the deal. So that's kind of something we all kind of pitch in. There was a $10 million raise for this deal, and I'm going to give a little secret to your listeners. Not very many people, and by not very many people, I mean no one that I know, raises $10 million by themselves. Okay. Yeah. So they all work together, and again, if you can, great, that's phenomenal. But for the rest of us, we actually work together. And that's really the key. Syndication is a team sport, and it's about working together, figuring out strengths and weaknesses, and how can you help each other. So we helped raise capital, but also I lend my eyes from a marketing standpoint. I bounce ideas off of the lead sponsors, as you mentioned, and say, hey, look, do you think about this? What about this? Actually just spoke at the IMN conference last week here in Chicago and talked to a couple tech companies where we looked at the different tech packages that they have. My sponsor was actually at the event with me. So we sat down and had dinner and talked about, hey, well, what would it look like for a tech package? Should we do this? Should we do that? What kind of rent premiums do you think we could fetch for that? So we go through a lot of those different things and just understanding, okay, how do we make this deal even better than what we projected, right? So there are things like that we do. And then, as I mentioned, investor relations, we do a pretty good job of reaching out to our investors, keeping them in the loop, reaching out. We reach out monthly on our communications and talk to them all the time about what's happening, and giving them proper updates, and then quarterly financial updates. So making sure that we're talking to our investor base and keeping them in the loop and making sure that they feel comfortable with everything, building any questions, and then obviously helping with any kind of K1 distributions and all that kind of stuff too.
Got it. Got it. So let's talk about any lessons learned that any mistakes or any lessons learned, on this specific portfolio. And then, we can also talk about your journey throughout your investing career, just any lessons learned here.
So I would say, I think for this portfolio in particular, I think the biggest thing is just making sure you create enough time to reach out to your investor base. We're developing and have a very strong growing investor base, and I want to make sure that people who are interested in these kind of opportunities have a chance to fully review the opportunity and kind of have a discussion about it. So we ended up spending a lot of time talking to investors, but I think there were some investors who we maybe didn't get around to talking to, primarily because when we reached out to them, we didn't really hear anything back. And then, someone said, hey, this deal is not really the right deal for us right now, which is fine. But ultimately, if I'd love to be in a situation where we can reach out and just talk to everyone who's ever raised their hand with interest. But these deals are also first come, first serve. So when they're first come, first serve, like they are, we kind of work with those investors who've raised their hands first and then kind of go through our list. But, I think one thing I'd love to do is get to, where we can bring in more investors into future opportunities. So that's, I guess, the lesson learned is just, like I said, having a little bit more time, which again is tough because, these deals are, people are investing $50, $100, $200,000 more, and they have questions. So you want to make sure you can answer all of their questions when you're looking at a deal like this. So we certainly make sure we take the time to answer all questions. But when we're, when we're trying to make sure that we follow up with everyone who's ever expressed interest, that becomes a little bit tricky.
Yeah, and part of knowing those answers is knowing the property, knowing the business plan, knowing the market, and somebody's going to ask you a question, you may not know the answer, but you got to do your best to find out as much information as you can. So I want to ask you, because we are in a pretty much a heated market cycle today, it's for those of you guys out there, if you don't know, I mean, we submit a ton of offers and not everything gets accepted, or a lot of them don't get accepted, and a lot of these properties, when you're underwriting them, they don't make sense. So what are you doing to adjust your underwriting these days, to kind of predict, what's going to happen next? Because we don't know what's going to happen, right? So what are you doing?
Yeah, that's a great question. I want to answer this in two parts. So first, what we're doing is we are being a little bit more conservative. The way we're being conservative is we're projecting an exit cap rate higher than the entry cap rate. So that's one way we are looking to, again, mitigate risk, being more conservative, protecting our investors' investment. That's one way we do it. We are focusing on value add. I think that's a really important piece of it because we're not buying just yield properties where we say, okay, hey, this property's kicking off $100,000 in NOI. We're gonna, get it up to 106,000, and that's it. No, we're looking for value add plays where we can drive the NOI. The reason that's conservative is worst case scenario, if the cap rate does expand, that we still have created more value. So we're not losing money. We're not losing any of that equity. Now, maybe we don't hit the projections as much as we like, but we don't lose the money. And our number one goal is to protect an investor's initial capital. So that allows us to do that. The third thing is we're looking more closely at the loans. The loans are a big thing. If you talk to anybody who lost properties from 2008 to 2010, more likely than not, the reason they lost is because they were multifamily specifically. The reason they lost was because they had a loan come due and they couldn't get financing to extend. So they had to sell for whatever they could get. So ultimately, that's one thing that, and I don't think anyone's predicting that kind of economic crash to happen. But nonetheless, we are paying more attention to the loans. We're making sure that we have extensions. We're making sure that we have longer term loans in place. And we want to make sure that we have some flexible terms where we can kind of control that. So we have that option. We can pull the trigger. The thing that I loved about this deal we just did is it's 3 years interest only, but there's no prepayment penalty. So if the market does start to shift, we can always say, you know what, let's go ahead and make a move, pull the trigger and sell this one or sell both of them, or package this up as, a portfolio and take it to an institutional investor. But we always have that. We can do it pretty much at any point in time without a prepayment penalty on this portfolio. So while, the loan terms are, and it's a 5-year loan or whatever, but I like the fact that we can control when we exit. And that gives us a lot of flexibility. So, typically on something we're looking to hold longer term, we're looking at longer hold periods, so maybe up to 7 or 10 years. And we're underwriting with that in mind as well. So I like having that kind of flexibility. So those are some of the things that we're doing to be more conservative. And then I want to hit the second piece though, because you touched on the depreciation benefits, the tax benefits of multifamily investing. And I think when people talk about the cycle, one thing that I don't hear people talk about a lot are a couple of factors that I think are really driving it. So one is you have a global economy where a lot of international investors are looking to invest in U.S. real estate. And I think that has driven cap rates to be more compressed. The second thing is with the Jobs Act, and I think this even impacts people like you and I. With the Jobs Act, you now have the ability to bring in non-accredited investors into these deals. Now, because of that, more and more people can invest in large-scale multifamily. And this is all about supply and demand. Demand was constrained for a while. And now that more and more investors see the benefits of real estate investing, more and more people are buying real estate, and in particular multifamily. So I think that if you're looking at where we're at in the cycle based on history, you may just be missing where we're at. I mean, that's like looking back at things and saying, well, people watch X amount of DVDs, or people watch, this much TV, right? Or here's the
Yeah.
Nielsen ratings from, last 50 years, say such and such. Well, stuff changes.
Yeah.
So,
Yep.
and I think this is one of those things where the investing options open up, not to mention even the banking systems, I mean, you have the fiat system being challenged by cryptocurrency. I just think that there are a lot of things happening from an economic standpoint where if you're truly just looking at historical cap rates, and if that's the only reason you think multifamily is at the end of the cycle and things are too hot, and I'm not saying it is or not, all I'm saying is there are more factors that people should be taking into consideration that I don't hear anyone talking about.
Yeah, I love it. One thing I would say is real estate is basically in multifamily, single family, whatever, is basically on supply and demand. If there's a lot of supply and very little demand, then you're not going to be able to sell it for too much. There's going to be too much of it. If there's a lot of demand and limited supply, like there is today, and there continues to be, then real estate is always going to be. It's going to be hot. It's going to continue to be hot, and it's going to continue to be a great investment. So I would say that if as long as you are conservative, like you mentioned, you do an exit cap that is higher than your purchase cap rate, and you're getting longer term financing versus doing a 5-year term like a lot of people were doing just 4 or 5 years ago. Then those are just two of the things. Obviously you're looking for a value add play, that's where you can mitigate some of the risk as well, and overall be in a market that is going to support it with job growth and population growth. If there's people moving in because of job growth, then there's going to be a bunch of demand, and so therefore it's going to be a good investment. So everything all kind of ties together like a big puzzle. And, you have to make sure that you look at every single piece of it. So, I love that explanation that you gave, and it was very insightful. And, it's, for you, those of you guys out there that think that there's not any opportunities out there, then, you probably should look a little bit harder and, find out that there really is opportunities no matter what part of the cycle we're in, as long as, everything checks the boxes like you mentioned, and so I think it's a great, great point that you brought up there. So it is time for our Nuggets of Wealth, John. So we will get that started. And these are questions that I ask every guest every week, and hopefully they are able to help out our audience. Question number one, what is the key tip or advice that you would give to newer multifamily investors that want to do the first syndication, or maybe they want to do their second syndication? What would you give? What kind of tip would you give there?
Figure out what you're missing or what you need and just take action to get it. If you don't have the capital, start talking to people. Start talking to investors, start talking to other syndicators and ask them questions, listen to these kind of podcasts, commit to wealth like you talk about, Juan. That's a key thing. So I would say take action on that, figure out what you need and take action.
Great. What is a good tool, source, or platform that you use almost every single day that can also help others?
Every day I use, I try to connect with my investor database. So that's through many of the social media platforms. I'm active on Bigger Pockets. So I use those platforms frequently. So that's probably the biggest one I would use.
Okay. Bigger Pockets. Yeah, that's a good one. For those of you guys that haven't checked out Bigger Pockets, it's a wealth of information. There's a ton of guys that have a ton of experience, from single family to, retail to multifamily to whatever. Check out that platform. They also have a good podcast as well, so check that out. Bigger Pockets. What was the best business advice you ever received? I think you kind of touched on that with the first question, but what would you say here?
So I had as an intern, I had one of my bosses tell me to follow what I really wanted to do. So follow your heart, and the money will come. And I thought that was really good advice. At the time, I was exploring a couple job opportunities, and his advice to me wasn't, hey, stay here. It was, do what your heart feels you want to do, and then don't worry about the money piece of it, because you're going to kick ass in what you do. Just kick ass, and then the money will come. So I think that's really the best thing. And I would say the same thing for any of your listeners, especially those who are aspiring or starting out and trying to figure out, well, how do I do this? How do I make that transition? Just start. If you love it, just dive into it and just start making it happen, and then the money will come.
Love it. What book are you currently reading today?
So my buddy and my coach, Joe Fairless, just wrote the book on apartment syndication. I think it's the best ever apartment syndication book. That's a good book. So I'm reading that. I'm also reading, I'm finishing up now, Chris Voss's book, which is Never Split the Difference. So those are two books that I'm in the middle of reading right now.
Yeah. And I do the same thing. I start book, and then, then another book that I haven't read, then I'll get into that one. And so I'm like, then I find myself reading two different books, and, I can't finish one of them because I'm reading two of them at the same time. So it's crazy.
Yeah. The funny thing is I use Audible. So like on Audible, I can go through a book like that same day, no problem. But if I'm physically reading, a lot of times I'm in the car driving or something like that. Mm-hmm. So it's a little harder to, and even on the train, if I'm going downtown, it's kind of hard to read.
Yeah.
Pushed around. So
yeah. I have Audible as well, and I think is great. It's good, to multitask, and I like having the hard covers.
Yeah.
I don't know. I just like, it's something about it, just having the book right in front of you. But I do like listening to Audible as well. Where do you see your business and company in the next 5 years?
I'll continue to grow. So I'd love to be in a position where we can grow out our staff and our business and really continue to be in a handful of markets that we feel are strong, growing markets, balancing that with more cash flow value plays, and just having a strong portfolio so we can provide all the opportunities to our investors and continue to grow our investor network.
Okay. At the end of your life, how do you want to be remembered?
I want to be remembered as someone who helped people move forward. Creating platforms, education is a big thing for me. In particular, from a financial education standpoint, it's something that's become more and more of a passion. It didn't really start out that way. I think I started off more as, hey, I want to create wealth for me and my family and hustle for my last name, as my buddy Jay Morrison likes to say. But as I dug deeper, I'm a part of an organization with the Chicago Urban League called Impact. And as a part of that process and the trainings we went through there, I really started to uncover a couple key statistics. And one in particular is we talk a lot in this country about income equality. And there's a ton, if you're in politics paying attention, you hear a lot of people talk about income equality, the minimum wage, and all of that. But the real issue in this country is wealth equality. And there's a stat that I read that kind of just blew my mind. And for people who make the same income, an African American who makes, let's call it 43,000, I think is the median income. So 43,000, if you have a white person makes 43,000 and an African American makes 43,000, that African American has 8 times less wealth than his white counterpart. And I think that's just a staggering number, because we always talk about, we're taught to go out, get good jobs, go to college, get a great job. And that's really the key to success. And it's not. The key to success is accumulating wealth. And you accumulate wealth through income producing assets like real estate. And it's the reason I'm so passionate about real estate and why I want to talk to people and why I want to educate people. And this is everyone. This isn't just African Americans or Latinos or whatever. This is everybody. But I do realize that when I talk to investors, it's very interesting the response we get. So I want to just make sure that I'm focused on educating people and letting them know that, hey, there are opportunities out there that you can grow wealth, and not to be scared of these things, because a lot of people just aren't exposed to these opportunities. So I think that part of what I'm hoping to do is expose people to these opportunities to help them create wealth for their own families as well.
Yeah, that's great. I mean, that's what it's all about, is sharing the knowledge, and providing opportunities to others that they otherwise wouldn't have had, if you didn't bring it to their attention, and, just give them the option, that's what it's about. So yeah, that's great. Where can Commit to Wealth Nation go to contact you and find out more about what you're doing and your company as well?
Yeah, you can go to our website, targetmarketinsights.com. That's the easiest way. You can also email me at john@casmoncapital.com. Those are 2 great ways to get in touch with me. I'm on social media at jcasmon, but go to the website or shoot me an email.
Okay, got it. So John, man, it was great to have you on. I mean, you gave us a ton of bullet points and, a ton of knowledge and value. So I greatly appreciate that. And hopefully my audience was able to pick up a couple of things from what you gave us here and shared with us. So, I wish you continued success in your journey.
Thank you, Juan. Appreciate it, man. It's fun to be on the podcast. I love the Commit to Wealth platform, and hope you get more and more people who are taking that action, taking the steps, and committing to wealth.
Hey, I appreciate it so much. Yeah, thank you so much.